The market caused by interest rate rises a few years back. I remember when that happened, and it was like the summer of 2022. We had the first big interest rate rise, and overnight the cap rate increased by like 100 basis points, and nobody was buying. I think we're seeing that even more today. We're probably standing maybe even 200 to 300 basis points more in cap rate. There's not a ton of buyers.
We called it Nimble because we knew we were launching it in a really rough time of our industry, and we would have to pivot a number of times to figure out where we fit in this ever-changing landscape. 3.5 years ago, rates were really shooting up. We all thought it would last 6 months, maybe 12 months, and we're still in a weird phase.
The future of this industry is going to tick down the scale from large aggregators to smaller and medium-sized operators. The more I do this, the more I realize if we're going to have any future here, we actually have to go smaller and smaller and smaller.
Institutions being on the sideline, we haven't had that for a very long time, and now we actually have had it for a year or two. There's probably good certainty that they're going to be on the sideline for a little bit longer. So I think there's some opportunity.
Hey everybody, this is Adam Stern and Ted Ferry for Ted and Adam Unleashed here on EverResi Media. We got a good show lined up for you today. Good friends and longtime colleagues in the SFR and Build-to-Rent space, Sanket Kumar and Josh. Sanket, how you guys doing today?
Good. How are you guys doing?
Good,
Great
man.
to see you guys. And I think we're all fresh back from Miami here. It was always good to connect with everybody in the industry, and you two in particular. So thanks for joining the show.
Yep.
Yeah, thanks for having us on. We're excited.
Well, Josh and Sanket, like we've known each other for a long time, and we've all had very storied kind of experiences in the SFR build-to-rent space, like going back to like the early 2010s. And you guys launched Nimble not too long ago. I think a lot of people know the name and, understand kind of what your background is. But, for the audience that doesn't necessarily know you guys and doesn't really know Nimble by name, just you want to give us a brief overview of kind of where you came from in the SFR space and how you landed with launching Nimble?
Yeah. So my name is I'm Josh, and I've been in the space probably since 2011, 2012. I was living in Denver, flying out to Houston for the Super Tuesday auctions, helping a group, analyze, drive all the homes, go out there and bid on them, and kind of just figure out what we were really doing when prices were really low. I'm from Phoenix, so eventually I moved back, got on with one of the first publicly traded SFR REITs called American Residential Properties, which is where I got working with Adam when he was at Own America. So bought a few thousand homes on the acquisition side with him, and his team became good friends. And from there, just kind of stayed at a number of different smaller shops in this industry, seeing it grow from, hey, we're looking at Zillow to maybe guess a rent to all the new technologies out there to make underwriting and acquisitions much more efficient. Sanket and I have worked together for a number of years at his previous shops. And as we were kind of just talking, we decided we wanted to form our own thing. And we came up with the idea of Nimble. We called it Nimble because we knew we were launching it about 3.5 years ago in a really rough time of our industry, and that we would have to pivot a number of times to kind of figure out where we fit in this like kind of ever-changing landscape. Now, obviously, 3.5 years ago, rates were really shooting up, prices were shooting up. We all kind of thought it would last 6 months, maybe 12 months, and we're still kind of in a weird phase. But true to our name, we've been able to figure out a number of different ways to make ourselves relevant and help our clients out. So our goal is to make scaling acquisitions and dispositions easier. We've done it across the country for a number of different funds. We have a brokerage internally. We have technology that Sanket can go into more that makes that a little bit easier. But our goal is to take as much pressure off of our clients who want to deploy capital in the SFR space as easy as possible. So we have an underwriting team, we have our brokerage team, we have our transaction team. So people can either hire Nimble to run the full process, source, underwrite, transact parts of that process. And, while it's still difficult to buy, we managed to find a number of clients who are very active and help them grow their portfolios in a strategic way.
Yep. Well, that's awesome, man. I got to know you when you worked for ARPI, and you were actually on the acquisition team where we were sourcing inventory and you were underwriting it and telling us either here's your offer, here's what we can't offer. So we had like a love-hate relationship at the time, but I loved you, for the role that you played. And I kind of met Sanket in the same way. You worked for 643 Capital back in the day, and you were kind of in the same spot where we were sending you inventory and you were underwriting and telling us why it didn't work or why it did work, and we got some deals done, man. So yeah, thanks a lot for that, Josh.
Great to hear the background story on how you guys came up with the name of the company. I always wondered why you guys were so dynamic. 6 months, he's turned into about 4 years, right? So
we had like not good names, but the word Nimble kept coming back. And then I think NIMBLE, there's a venture capital firm in the Bay Area that's, taken that kind of .com. And so we added the H after the N, kind of made it look like a house to, as it relates to our relevant sector, and kind of went with it. We couldn't come up with, out of that 200 plus name list, it was very hard to come up with an agreement, but we kept saying Nimble. We're like, let's use this word. Everyone says Nimble, I think, in our industry, every conversation that we have. So hopefully it sticks with everybody.
Yeah. Picking names are always the hardest thing about starting in a company or venture. It's not as easy as it might seem. And I don't know if you want to view this in a different direction, Ted, but like something that Josh said is pretty relevant for today, which is like Nimble being able to help scale acquisitions for large scale investors. I mean, we're facing a time where like large scale investors are being demonized and like via legislation being pushed out of the market. So like for my side, I run a brokerage that sells, inventory from small investors to large investors. I'm almost looking down the road, a mile or two and realizing maybe those big investors, they're not going to be there anymore as an exit opportunity. The idea of helping institutional or fund investors scale to larger and larger portfolios is exactly what the legislation that's pending right now is designed to prevent.
Yeah, I mean, and I was just going to say technology, I think, is important and valuable as ever in all of this, especially in scaling. I think, because of the need to, transition everybody's platform, and, we're all having to be more nimble and, act lighter, right? And do more with less. I think technology becomes key in that. Sanket, I know you are, originally kind of came out of the Silicon Valley area, and along with that have a lot of technology in your background. Like, what's your view on all this?
Yeah. I mean, technology is definitely on everyone's mind, even more so than ever. I think, if we go back to kind of the growth period of the industry when it was, I would say, more heavily an appreciation play coming out of the growth or the GFC for a number of years, of course, I think a lot of firms they dabbled in technology, but they kind of didn't have to do it because they were just using brute force to scale up and buy as many properties. There were a lot of times where, especially like when interest rates went, basically down to zero during COVID times. Like once we kind of got a little bit out of the initial effect of COVID and rates fell as a response, everyone dropped their rates significantly and bought everything that they could. Every group was trying to just buy. And so in today's period where interest rates are higher, obviously we see AI in every little article possible today, and so many companies coming out of the woodworks, bringing technology. Technology is easier to implement than ever. It's cheaper to implement than ever. And I think groups, now that they're more focused in terms of raising money, they have to focus on good performance, right? And driving performance and showing that they're capable of making very good decisions, not just getting scale, but now they also have to show that they're really performing. That's where technology is going to have to shine. And I think a lot of companies are investing in technology. We have a company called Honeycomb that I run, but it's all of our minds together running the company. And, we're dealing with those clients quite a bit and helping them provide solutions where, hey, we operated in 10 different silos. We need a platform where we can engage our customers all in one place. And so we've built kind of this customer engagement marketplace that a couple clients and are using to reach out to their customers in a much more effective way. Asset management, we have a platform there where we have numerous clients, and doing things in spreadsheets just without being able to scale teams. There's just much more efficient ways to do it in a platform where you have data in different silos and we need it in one place. And now it's just much easier to do. And now we can create insights on your performance. And I think, for groups that want to grow, they have to prove those decisions, that they're making those good decisions, that they're running smooth operations. And I think that's kind of the wave of the future. And that's where groups have to show that they can perform to continue to grow.
So, Adam, I think getting back to your question here about where things are with Washington and the political environment, I mean, how has that changed things for you guys? In Sanket, you're talking about your customer set. Has your customer list changed because as a result of any of this? Are the institutions, less active, or are they doing anything now?
I don't want to go into like everyone's particular situation. Definitely a lot of the larger players who may be in fact impacted by this legislation are kind of in a watch and hold period. They're doing things, they're kind of trying to stay unnoticed, right? So large scale acquisitions, they're holding off. We're talking about like, top 5, top 7 groups in the SFR industry. So they're kind of holding off. They may be doing other things like getting into new construction and build-to-rent, which the housing bill does kind of support. And so, one of them made a large kind of home builder acquisition. Another one has a pretty large and growing home building division. So they're buying land. They're investing in build-to-rent communities and new construction homes. I think it's helped the smaller mid-sized groups, which, where Nimble and Honeycomb have had even more success of, going after retail investors, going after, whether that's through us or via, our clients, to help them grow and scale, but also small to medium-sized institutions who can still deploy capital, stay under the radar a good bit, and are willing to, they still have capital to deploy. I think everyone in the sector does, but those routes can more effectively do it. They're kind of doing it while those big players are on the sideline. And, in terms of technology, we're still chasing everybody. I would say we've had faster and quicker, adoption from small, medium-sized groups, which is pretty natural, I would say, but it doesn't mean we're having, no conversations with those big groups. I think they're certainly interested in technology, but they take a lot longer to win with the longer sales cycle. So, we're attacking both, given we have conversations with both, but we're definitely having more success currently with the small, medium ones who can just be more nimble and move faster, plugging Nimble's name into the conversation there.
So like it is a comparison. What's the percent of your customer base or your business of small to medium size investors versus institution, like this year, like maybe before this year, and how did that change this year?
Yeah. I would say it's a pretty good mix. We have a couple, really large clients and a handful of kind of small, medium clients. Coming out of the conference in IMN, we're having a lot of conversations with some mid to large institutions. So, they want to talk about asset management and, interest in our, marketplace product as well. So, it shifts like every 6 months. There's like different priorities sometimes given the environment that we've been in. And so definitely still continue to have more success with the small, medium size. And I would say like, the big companies, they take a long time to integrate. They take a lot more resources to integrate. So it's kind of like we can only absorb so much being a startup from a large client, and we can win a lot more off the small, medium size because we can just integrate them a lot faster into our solution. So that's just kind of the natural order of how things have been going. No major shift one way or the other. It's just, a sales cycle challenge. And then, the political environment can cause some of the bigger institutions to kind of hold off on making some big decisions.
Yep. I was thinking that, part of the great thing about having a technology set like the ones you guys have is being able to kind of make the shift from the business that, I could talk about Strata and what the business we were doing, mostly sales to large institutions. And then interest rates rose and the market kind of shifted, I kind of came to the realization that our only safety was broadening the buyer base that we actually dealt with, because you can only depend on large institutions to buy inventory until they shut up a spigot and stop buying in that market, or until something happens like a legislation that's going to prevent them from actually buying more. And I think the future of this industry is going to tick down the scale, from like these large aggregators to smaller and medium-sized operators that might not be, buying properties strictly to aggregate, but to add to their portfolio, to have a different asset class, to have all the things that SFR Build-to-Rent offers. And I think, like, for my firm, being able to kind of, grab hold of the smaller investor, figure out how they underwrite, figure out what they're actually looking for and why, and then provide opportunities. We're a brokerage company, so our key is finding sellers that want to exit and giving buyers the opportunity to see those assets. Like, the more I do this, the more I realize if we're going to have any future here, we actually have to go smaller and smaller and smaller. And the smaller you go, the harder it is, because, you got to deal with more people, smaller transaction volume, smaller fees. It's been a real challenge. And, like, part of the thing that I see in technology companies, I think that's going to make them win, is the ability to actually create technology that allows you to, almost scale down on the type of clients that you service. So you don't only, have the big clients, but you can actually have more and more small clients to keep the business thriving and growing as well. So that's just the way I look at technology. It allows us to go down the scale from fewer clients to more clients more efficiently.
Oh yeah. So I think that's how we think about it a lot. I mean, like, all four of us, right? We kind of grew up in this industry with large institutions. So naturally that's who we work with. We know how they operate. It's always cash. You have a defined buy box. You find the home meets that buy box, meets your yield criteria, they buy it. Let's just say now that's not as easy as it was. And depending on how the legislation does shake out, there might be fewer opportunities to do that. So you do have to go smaller. One of the challenges, there's a few challenges with that. It's just a smaller buyer, especially mom and pop buyers, they like their local product or local agents, and they don't normally work with a lot of groups that come in to say, hey, buy these homes. But then there's also, like, an efficiency and scalability challenge to working with smaller groups that you as the service provider have to solve. And that really can only be solved with technology, because you can't solve it by hiring a bunch of people to make a bunch of calls. You have to gain efficiencies through the technology, through your sourcing platform. But then what you have to do is, and I really think what we do a pretty good job at is going, hey, smaller buyer, why you should work with us is now you gain all these efficiencies that our larger institutions have gained. Debt partners, discounts to properties that you may not have access to, but since we do so much volume across all of our clients, you're grandfathered into that. They're not looking at you, the one investor buying 2 homes a year. They're looking at Nimble bringing this all this business. And so that's how we sell it to our buyers as well as we go smaller down. So it's it's a different tactic for sure. We've had to adjust to that as we've kind of grown into that, but it is very, very doable. I do agree with you, Adam. Like, you have to diversify your buyer and seller pool. If not, you're just going to be paused for 3.5 years.
So, I mean, if the industry is moving towards, new construction, BTR, because of the legislation, it was already going that way. But if the legislation is pushing it more down that path, at what size is a new construction or a BTR project really not viable for a client? Like, I guess said another way, the question I'm really trying to ask is, like, is BTR really an option for a smaller client?
I just had a conversation in scale, maybe not as much. It's a little bit tough, but I literally just had a conversation yesterday with somebody who was like, hey, do you know of any, like, 25 home developments? I have a bunch of partners. We would like to do one of those, stabilize it, and then see if we can go do another one. Again, that's not like he's not going to go do 4, 5, 6 of those a year, but are there people out there that you can do enough of that business? I think that's yet to be seen. I think we might see a pivot into that. And you can stabilize 25, 30 home developments and either hold it or you can sell that upon stabilization. So I'm not quite sure what like the larger market of that is in scale, but I do think there's going to be a market for that.
So is that like
And
aggregating, like somebody comes to like a platform like yours or Adam's platform and they're interested in getting in front of deals? Do you envision that you would act as like a facilitator to kind of help aggregate the capital among those clients?
yeah, I think you can do that. And then, Adam, I think you're going to see a lot too, if you haven't already, is, but now you can say, hey, but I have this builder partner who can definitely do this cheaper than what if you just went out and hired and fee built somebody that you hired locally. We have partners with debt options for this type of product as well. So you can be the one-stop shop for people who may not know how to do that type of development. But now there's availability for them in there, and there's safety in that, in the bill, saying this is something I can buy and hold long term, hopefully. So I think there's a number of different ways where you can leverage our expertise in this business.
Yeah, like Ted, it's interesting when you use the term like our industry, because I wrote an article not too long ago talking about the fragmentation of the SFR space, and like when we talk about our industry, like the industry that we started in was large scale institutional investors aggregating SFR, and that turned into build for rent, and that is the industry we all kind of know. But I think the definition of our industry is going to be changing over time. There's like that component of it where you have operators raising capital to buy build for rent, specifically, build for rent as, as a strategy. But then you got all these different segments, like smaller operators that are self-capitalized or maybe have like private investors or family office money, and they're not in it to aggregate. They're in it to invest in good projects or invest in certain markets. And that's like a completely different like thesis at the original industry that you talk about, right? And then you have
Right, and that segment has probably been there for decades too.
that's
Right?
never disappeared.
I
Like been there forever. They've always been
institutional folks really kind of came in and butted in on their industry, right?
Yeah.
Yeah.
It's kind of like we came into the industry with like all the money in the world, and they were kind of standing there watching us do it, and we made them smarter and better by creating, technology was created for that exact thing, aggregation, and that I think helps medium-sized investors. But like then you have all these smaller investors that are apart from what even medium-sized investors are doing. They just want to own a house or own a rental, and have that passive income and have that tax benefit. So like when you talk about our industry, I think the definition of the SFR industry is going to change over the course of the next number of years in terms of like what these different investors actually want to accomplish, whether it's like aggregating at a large scale, whether it's actually just finding good assets to invest in, or whether it's like small scale private people just wanting to buy an investment or two. And like to me, that like points to a massive amount of opportunity for people that understand technology, that understand how to source buyers, source assets. It's like you're going from a room with one or, a handful of giant operators in it to a room of like thousands of people with all kinds of needs and goals. And
100%. And really, we've saw this starting to happen. Well, not really starting to happen, but happening a lot more. Really, the last 2 to 3 years, where the kind of the rental industry and the builder industry were starting to kind of collide and get more ingrained. But I think the overall goal of everybody is to provide housing for people that need housing, right, and provide quality housing. And I think that all of that ends up with I think what you're saying, Adam, is that there's just going to be a lot more paths and opportunities to be able to of ways to provide that housing. And whether it's new construction, owner occupant, buyer, or if it's a build for rent community, or just an obsolete house that was like made stabilized and made turned into a viable place for somebody to live, a good home in a good neighborhood, right? So
I'm going to go on a limb here, Ted, and like readjust like my view of people, why people want to be in this industry, why people want to be in real estate. And like, I think providing affordable housing and great housing is the vehicle. I think people come into the industry wanting to make a lot of money. I think they want to build big companies and build wealth. And like that, to me, that's always been the SFR segment. Use the asset class to build wealth, to build a company, to build like long-term, like generational wealth. And I guess what I'm pointing to is like, I think now is a time when obviously like building affordable housing, building good housing for the United States, or in the markets that need it is absolutely necessary. I look at that as the kind of the vehicle toward the end of everyone on this call, everyone that's in the industry, figuring out how to, use this industry, this asset class as a vehicle for wealth building. And I think there's more opportunity to do that now than there ever has been, right?
Yeah, it's a brilliant point, because it's one of the reasons why people look to SFR because of that is because it's an attainable purchase price, right? Everyday folks that, are not big institutions sitting on a ton of capital can enter the space, right? And I mean, I think that's kind of an interesting question for you guys, Josh and Sanket. Like, how small of an investor do you work with? And then, how do you get in front of them? I think we all, go to these industry conferences, pretty frequently, and, that's a big source of business. But are you doing like direct advertising through, internet ads, or how are you getting in front of people that, let's say, don't show up?
Yeah, our smallest buyers will buy a couple a year, right? Like if that's what it takes, we'll do those deals. A lot of that right now is honestly word of mouth. I think we've had a number of people that don't necessarily are not equipped to handle those types of buyers. And I think we are. So they would just refer them over to us, and we have a quick conversation, and then those buyers, they find out they have access to all this inventory they never would have seen before, if they just stayed in their local markets, and sometimes getting pretty significant discounts to what retail would be on both new builds and in existing product. So we've not done too much external marketing right now. The nice thing with Honeycomb that Sanket's really done a good job at pushing forward is we can build marketplaces for our clients. And so they might have thousands and thousands of investors in their ecosystem, depending on what it is that they're doing. And these are mom and pop buyers for the most part. Some of them own like 50 to 100 homes, but a lot of these are smaller. And then it's just like, cool, now they have their own portal to log into, and Nimble can just feed homes through it. And it's kind of direct access to mom and pop buyers that we may not have had access to. So you kind of take, it's kind of like I said earlier, you kind of take that institutional scalable efficiencies and you bring it down to the mom and pop buyer, and they love it because this is just not stuff they would have seen before. I do think as we grow, we'll want to do more marketing towards that. We do have our own marketplace that right now is still mostly institutional, sub-institutional funds that will get to the more mom and pop buyers, but that's been a great avenue for us, and we see that growing. I think to your point, I think if the larger investors cannot go buy a lot of this one-off stuff, the demand for mom and pop and maybe a little bit bigger investors is going to keep growing, and they just need a way to see that inventory, quickly make a decision, and then have a way to make an offer, and that's what we're trying to provide.
So what for Honeycomb, I'm just interested because, Roofstock had a marketplace for a long time. There's been several, kind of tries at marketplaces. And for one reason or another, I personally think it's a very difficult model, right? Because not only do you have to bring buyers to the platform, you need to bring sellers to the platform. But then once they're there, you have to get them to actually do business, right? So, and there's a ton of alternatives like Zillow, Redfin. Like why is Honeycomb different than like Zillow? Like why can't your client just go to Zillow or Redfin?
Yeah, I mean they certainly can, and they will. These things also feed through our marketplace. Certainly not our focus to have them shop there, but that's definitely a component. With the clients running our marketplace on top of Nimble having one, it's the integrated solutions. It's better buy box matching, better tools to help them get the properties that they want. We can more easily study their buying patterns. Like a lot of this stuff just becomes more efficient and easier to do than 5 or 7 years ago when I was at Roofstock and we were trying to do things. Like it's just a lot easier to understand buyer behavior, give them what they want. Obviously, every property that hits our portal is automatically underwritten, then it's automatically matched to these, tens of thousands of buyers that we have on our platform. And so they get fed what they want. They can constantly adjust what they're looking for. They can change their assumptions. They can change how they're approaching underwriting. And there's just a lot of tools to manage and and deal with the outbound with them that are a lot easier to manage than back then when there was still a lot of a manual approach to running a marketplace. Part of the problem with the marketplaces of the past is how much manual effort went into it. And then it also became, is this worth the dollar amount that we're making, or how much we're losing every month? And can we get to a certain scale? And now we're at a really good point where technology has gotten to a point where it becomes a lot more cost efficient to run and to reach all these customers. One of our largest customers, they have all the services in-house. So they can offer basically the whole life cycle in-house. And then if we add all the tools that go into property management, asset management, and if all that's integrated in one place, that makes it much easier to buy and sell and creates a much more efficient and well-functioning marketplace. And I think, the biggest solve is always going to be, do you have the right inventory that people are going to look for, right? Most people want to buy or sell. And if they want to sell, they want to be able to actually have a buyer buy it. If they want to buy stuff, they want to see stuff that they can buy. So that's always the biggest thing that a marketplace needs to have. But we've integrated a lot of good inventory. Obviously a lot of deals don't pencil, but there are a lot of good deals still out there, whether you're flipping homes or, looking to hold them long term. And so I think that's just that technology difference and how much more easier it is to run a fully integrated marketplace is very different today. I think people continue to be more comfortable with using technology and relying on technology. And so that's also very, very helpful. And so I think this fully integrated marketplace, having all the tools in one place to see okay, if I want this insurance provider, if I went with this lender, to be able to see kind of the differences right away, to not have to go to a spreadsheet and do the math. You just do it all in the Honeycomb system and see all the pro forma and financials and different scenarios in one place. I think that makes the investor comfortable. It's still not easy. You still need to talk to the customer and work with them. There's still a lot of building a relationship. It's not just, hey, you're signed up, all that. Some of them are okay with that, but there's still a lot of
so a lot of traditional, just things that we've always had to do in the industry, right? I mean, it sounds like your platform is a lot of organization, right? I mean, it's tech, but really using tech just to organize things.
And I wonder how you focus on the relationship. Well, you don't have to worry about the tech as much. You focus on the relationship because the tech does what the tech needs to do. And that's, real estate is a relationship business. It always has been. It always will be. And I think that because the tech works, you're not spending time inputting numbers into a spreadsheet. You're not doing all this manual work that also took a lot of time. You're just spending time on the relationship. Nimble's spending time on bringing a lot more inventory, not having to manage the platform. The platform just does what it's supposed to do. And that's a big difference in something from 6 years ago.
Yep. I feel like, especially in the segment that at least I'm mostly focused on, which is not individual investors, but medium-sized and larger investors. The concept of a marketplace inherently kind of goes in opposition to what a lot of real hardcore investors actually want to accomplish. And you know this, Sanket, when you work at 643 Capital and I had a deal, and the first question that you had or you, Josh, when I said you deals, who else is seeing this? Am I the only one? Is this broadly marketed? And that idea of keeping things private and intentional and between two parties kind of flies in the face of a marketplace, because marketplaces are exactly the opposite, right? It's you put it on a marketplace and everyone sees it at the same time. That's been an extremely challenging thing for my company as we run a brokerage where we're selling properties and selling assets is very largely traditionally dependent on how many people you can get it out to and how many eyeballs you can get on it. And the most fruitful deals we've ever done weren't placed in front of a marketplace. They weren't placed in front of a crowd. It was I have this deal. I know what you want to buy. Here it is. Act upon it before 100 people standing behind you, get an opportunity to act on it. And I guess my question for you is that a challenge for you too? And what you run at Honeycomb, that idea that if it's on a marketplace and everyone can see it, it's naturally devalue in everyone's eyes because it's not private. Okay? It's not exclusive. And I guess that question is how do you navigate that conversation with buyers and creating that value so that they actually look at the properties and pursue that?
Yeah. So getting buyers to take the time to review, underwrite, and act is one of the hardest parts of our job. They're busy, right? Everyone's busy. Everyone's looking. There's a lot of people like us sending a lot of deals out, most of which don't work, and most of which should have been screened previously for their buy box so that they know they don't work. And so it becomes very difficult to get eyes on what you're sending out. I'll say for most of our buyers, both institutional, sub-institutional, all the way down to the very small ones, we don't have as much of a, hey, is this only going to me issue. Sometimes that does become an issue. But what we have the biggest problem with is if we got to a seller, they gave us a portfolio or they gave us a home. Okay, we're going to go get this in front of our buyers through the marketplace, through our understanding of what their buy boxes are, get it out in front of the right one. So we don't blast it out to everybody. We do make sure that it hits whatever their buy box is. But then it's like, okay, are you also sending this to a bunch of other groups as well? And has this deal now been seen 4 or 5 times by the same group? That hurts us way more than if the deal's not like necessarily exclusive. It is if that is daisy chained over and over again, it becomes very difficult to get that deal done. It does make it so that it makes it seem like that property isn't actually who's the actual owner of that property. Can we actually act on it? How do we make all the fees work now that there's 5 people involved? All of that becomes very difficult.
Like, why did the other person pass? Right? It's like,
yeah.
And people can't depend on their own merits of their own underwriting, right?
Exactly.
I was actually going to say, like, this actually correlates to the marketing question you had before. Like, what we do, and it sounds like what Honeycomb does, you know, and it's valuable, is understanding buyer behavior, right? Understanding what buyers want to see based upon previous behavior. I think that understanding of what inventory needs to reach what buyer, like that kind of solves the issue of who else is seeing this, because the answer is not everyone's seeing it. You're seeing it because it fits you. You know, maybe don't worry about the other people that also have eyes on it, because, you know, it's a free market and the property's going to get bought up at whatever the marketplace deems to be market rate. But I also think that's kind of an opportunity. Like as I look around at companies that are specialized in selling individual properties to like individual investors. I was talking to Chris Clothier from REI Nation earlier today. That's their thing. They build a big network of individual investors, and that they buy and create these opportunities to sell to their own investors, and they make sure they get good product with property management. You know, firms like Bigger Pockets and Bigger Pockets and the Real Wealth Network. These are all organizations that were built around the smaller investor. Like as I'm inching closer to launching our private marketplace platform, I'm thinking about ways to get inventory to smaller investors. And the more I think about dealing with small investors, I'm like, I don't want to do it. I don't want to touch it. My wheelhouse is like medium and large scale investors. And how do I leverage these firms that have been doing this for years to get inventory out to smaller investors? I'm thinking about this. This is the point where I'm always thinking, like, do they understand how their buyers buy and what they want to buy so they can put the right opportunity in front of them? And when I had the conversation with Chris this morning, like, absolutely. They've been doing that for years. They don't pitch anything that doesn't fit a smaller investor's buy box. So I don't know. I think there's an opportunity to like do what we do well for like the mid size of the market and a large size of the market, because those guys that deal with smaller and smaller investors, they don't have that access. You know, part of the call today was them trying to sell or not trying to sell, but just being curious about how to get at that middle market, a larger market. And like, I was pleased to hear that they hadn't been focused on that because they were focused on the smaller investor. Like, he was very happy to hear that I have no need and no desire to ever talk to an individual investor, and I might be able to leverage what they built, you know, at companies like Bigger Pockets, REI Nation, Real Wealth Network. So I think
what does the buy box look like? You know, as Chris is talking about those buy boxes for the smaller investors, like what does that actually look like? And is it actually different than what we would call an institutional buy box or a larger investor buy box?
From what I can glean, we didn't go into the buy boxes a whole lot. What I understand through the conversation with Chris and others like him, there's a need, right, for the small investor. They're trying to solve something. Some of them are trying to solve
Or
for
reward driven, right?
it's they're solution driven. So if they need if they need income that's tax sheltered, real estate's a way to achieve that. If they need cash flow, then real estate might be a way to achieve that. If they want to put their money into an asset that's appreciating, that's leveraged, that might be a way to solve that. I don't think there's like one buy box. We use buy box as like a normal term that investors use all the time. Like regular investors, I don't think like that.
They're very flexible. Yeah, they're very flexible, very deal oriented, and like Adam said, they have situations or kind of themes that they look at which change, and that's kind of they find deals that solve that theme, right? I think
it can make it add complexity or additional kind of time needed to try to match those deals though too, right?
Yeah, it does. It allows to like do it at scale, and then you see who's offering, you see who's active. You can at least see who's engaging. Kind of when you have a large number of customers, it allows you to kind of have a baseline. Obviously, if you have zero activity, that's not a good thing. But if you have a good activity, you can learn from that, talk to those customers, and see what made them engage, and kind of continue to train the technology to help build the tools that you need to engage customers, but also understand the buying patterns, what are people interested, what are they looking for, and continue to evolve the technology platform to make it better and better for people wanting to buy. It's going to be hard to like get 100% user engagement, of course, right? I think that's just impossible or very, very hard goal to achieve. But I think the marketplaces that we have, I mean, they're owners who typically have 5 to 500 properties. So there are some decent sized investors on the platform that have been actively buying. And, if we see something that they're buying, even though, like Adam said, they may have bought their last house for a certain reason, we can at least observe that and kind of see if they want to see that again or do something different based on some manual reach out, but also from the technology, like just helping us with the reach out as well.
That's interesting. So I think what you're saying is that like the customer isn't always coming to you with something like a buy box and telling you what they want, but you're looking at what they bought in the past and telling them what they like. Right.
Yeah. I mean, that's how you go. You see, you bought this 2 months ago. If you want to buy it again, Amazon does it all the time, right? It studies all of what you search and what you've bought, and kind of gives recommendations. I'm not saying we're as good as Amazon yet, but we had that data and we're using that data.
Sanket, is that, would you call that AI? Is that AI based? So like it's something I'm always curious about. There's like, seeing what people search, like YouTube, it knows what I want to watch. Google knows what I want to be advertised to. Like there's all this intelligence that was there before AI was even like a commonly like known phrase. Like that intelligence, is it gathered using on your platform AI, or is it something else? I was just curious from a knowledge standpoint.
To some degree, I mean, we've coded it, right? We've coded what we want it to do, and I guess over time, AI can take over what it's seeing and match it to kind of what we've already coded. So probably not like 100% AI, but maybe some people want to call it AI, but I think we are leveraging AI for some stuff, of course, but we're coding what we want to see right now. And I think over time we can train AI to help us continue to help us decide how we should tweak things, and it can really monitor everything a lot more efficiently for us, and then we can kind of make those decisions on how we want to make tweaks for improving things.
So that's interesting. So as a non-technology, like you're a technology guy and you have deep roots in technology. You mentioned hard coding versus like, bringing in AI later on to figure out, make better use of that information. Are those two totally different things? Like actually building something on an AI platform versus, as you put it, hard coding it? Are they two different ends of the spectrum, or two different ways of looking to build technology? One's AI embedded, one's quote unquote hard coding. I guess, what does that mean?
I don't think like AI, you still need to know what you want AI to build. I mean, AI can kind of learn what it knows or what it's reading on the internet or any files that you provide it, and kind of get a good understanding. But if you have specific things that it's not necessarily understanding, you still need to kind of train it to build what you want. You still may have to give it, data on what you want it to do, and then it can kind of go build it. So similar to like the marketplace, I don't know if that answers your question. I mean, hard coding is like our development team, like writing the code. We may leverage AI to give us, some of the code, and we tweak it, or we talk to AI and continue to manipulate the code to make it how we want to, or we test it and see if it's working, and then kind of make adjustments manually or using AI. We can do both.
The coding part is like more deterministic, right? It's like when you're saying what you want it to do, you hard code that, and then it's like you can count on it happening every time. But then when you bring the LLM in, right, it's like it's math and statistics, right? You're basically like queuing it up, like dishing up a prompt and, kind of pointing in the right direction. It's probably going to get pretty close, but it's really just a guess, right? It's like a high probability, kind of outcome from what comes back from the model. And so like it's helpful in some areas, right? But if you have that process like you're talking about, like you want it to run a certain way, it's got to be more deterministic.
I will say, like, based on the conversation with like smaller investors, medium-sized investors, all having a place to find out what the other's doing. Thank God for EverResi Media. Greg Frank did a great job putting this together. So like the biggest institutional investors and the medium-sized guys and people that create technology for smaller investors can all have one place to come to find each other. So thank you, EverResi Media. Thank you, Greg Frank.
Yeah, thank you, Greg.
Yeah. Please screw you for that.
Well, this is cool, man. We're gonna take the conversation right now, Ted. You're the big brain of the group. Like, is there anything else to talk about that's super important?
Well, I'm glad you asked, Adam, because I do have a direction I would like to take the conversation here. I think one of the biggest things left to talk about is just what's the opportunity in the market today. We talked about the changes to the market caused by interest rate rises, back a few years back. I remember when that happened, and it was like the summer of 2022, we had the first big interest rate rise, and overnight the cap rate increased by like 100 basis points. And nobody was buying. We were like one of the last like buyers left in the market. And I just remember thinking, I was like, all of these groups that were scratching and clawing to get a 4 cap. And then now there's vast opportunities of 5 cap, and they're nowhere to be seen. Like, how does that work? Right. And I think that maybe, I think the answer really lies in interest rates, and it's really kind of like a financing cost, question. But I think we're seeing that even more today. We're probably standing maybe even 200 to 300 basis points more in cap rate as kind of like the market opportunity. And there's not a ton of buyers. So, I mean, what do you guys think of that? What do you think the opportunity is today?
Yeah. No, that's definitely tough. I think the one thing I've been thinking of over the last 6 months or for all of 2026, especially once the bill got introduced, our industry has not had stability in 4 years. It's kind of what I would say, like consistent changes. And I do think eventually our industry can even out and adjust, and we'll get back to more of a steady buying point once we have some of those things solved. But for right now, we don't really have that. So, we've always talked about, I think on the institutional side, like, oh, we only own such a small percentage of all investment real estate across the country. And that's true. But that means there's a ton of opportunity out there that is not purely focused on that, like we've been talking about. So, and that doesn't just include buy and holds. That can be fix and flips. That can be looking at product that is not in traditional markets that institutions need to go to because, they're going to, well, how do I get to 1,000 homes if I go to this small market? Other buyers don't think that. Or this is a 2-1 with a really good yield, but institutional buyers don't buy 2-1s. It just doesn't meet their buy box profile. So how do we find those types of homes that do yield? Probably not, there's still a gap in pricing between what sellers and buyers want, but it's much more bridgeable on stuff like that, especially if you can get to the right buyer. So I think what we've discussed today is kind of how groups like ours are going to really push forward over the next 18 months, 24 months, hopefully not quite that long, but I still think, rates and prices will be high for a little while, but how do we win in the margins, and get more deals done that way? And then keep looking for your big home runs, right? We've done a 79 home build to rent deal, working on a larger 120 home deal in Orlando right now. I don't know if we'll get that one done, but supplement all your one-offs to all your buyers with some home runs. They are out there. They're hard to find. You have to really grind on them. You have to really work with your buyers, really work with your sellers. It might come back 6 months later because the seller's finally ready to pull the trigger on pricing. But I think that's the opportunity right now. And there's some other things that we're working on internally that I think we'll be able to talk about in the next hopefully few months. I think with everything going on, there's gonna be other opportunities in our asset class. But yeah, I think you just got to keep looking at different ways to do business, keep grinding it out, and you can definitely be successful in this business. It's really difficult right now, but I'm telling you, if you've done it for as long as we have, you come out of these 4 years and things start to stabilize, we're all going to be in really, really good shape because we've had to go through this. We've had to adjust. You've had to build the right technology and the right process. It's going to be really, really fun.
I think you better, talking about like Josh and like adding on, I think big portfolio trades probably on hold, for a lot of the bigger groups thinking about those types of acquisitions. I think I can't say it with a definitive like certainty, but I think the government does not want them to be in the headlines with that kind of aggregation. So I think those are on hold. I think for people, any real estate investor that wants to scale 0 to 300, 0 to 100, with a lot of the big groups, maybe they're still making some offers, but they're not going crazy. There's some opportunity to still get really good deals out in the market. There's technology to make that easier. And so I think to scale smaller portfolios, to have a very flexible exit strategy, I think that's still a very good play. I think there's technology to be multi-market. You don't have to just be in a local market the whole time. Like there's property managers that operate more so than ever across multiple markets, plug it into their systems quite easily, and you'll have technology to kind of give you how your performance is. So I think there's a big opportunity there for those investors while a lot of the large institutions are sitting on the sideline. Yes, you have to buy higher cap rates, so there's naturally less deals out there, but there are deals for those size buyers. Getting the right kind of debt in place obviously is helpful, and having that flexible exit strategy is great. I think, when there are opportunities to get land, like that's still a great opportunity. Obviously, knowing what you're buying is important too, but if build-to-rent continues to be a strategy, building new housing or finding different ways, it just seems like land is going to continue to get more expensive in markets. It seems like a lot of the institutions are pushing towards the Midwest like they have been in the last couple of years just because of the better yield opportunities, where the Sun Belt has pushed up quite a bit in pricing despite, still pretty solid population growth numbers. I think that focusing on that small, medium-sized investors or even smaller institutions looking to grow their portfolio and scale, I think there's a lot of opportunities given some of these groups are just on the sideline. Like Josh said, markets that they may not, big institutions need to get scale in markets. It may have been hundreds before, now it's like thousands, right? To get in scale in some of these markets. But there's a lot of good markets that are doing really well, have really good fundamentals that you can get pretty sizable portfolios in because the institutions may not go there. There are not your exit strategy. You need to be able to be comfortable with a one-off retail exit strategy or a smaller portfolio trade. But I think that opportunity is there more so than ever. Institutions being on the sideline, like we haven't had that for a very long time. And now we actually have had it for a year or two. And there's probably good certainty that they're going to be on the sideline for a little bit longer. So I think there's some opportunity.
So even with higher interest rates, there's still opportunity in the market. I view it as a great opportunity to capture yield. Maybe it begs more modest debt, and probably at shorter terms. You know, if we might be on kind of the higher side of rates here for a while, that gives you some flexibility. And I think Sanket, to your point, brilliant point. It's like you have to have flexibility on exit. So
yeah, it just my 2 cents on it. I think that being really intentional and kind of like hyper focused on like your core segment, whoever that is, and trying to solve the problem for your laser pointed core segment. I think during that process of grinding to do that, you know, a lot of other, you know, opportunities abound from that, right? So you're working on this for the small investor, you focus squarely on doing deals with small investors. And I think during a process like that, you'll find opportunities to work with other segments, right? If you're working with mid-cap investors and you're squarely focusing on getting the medium-sized deal done, and that's your entire world, well, if you do that for long enough, then other opportunities tend to filter into your universe. And I think that, you know, that's going to be the big determining factor about whether people stay in this industry, stay in this segment, and ultimately succeed in it.
100%.
couldn't agree more, Adam. Josh, Sanket, Adam, thanks for joining again here today on one more great episode of Ted and Adam Unleashed on EverResi Media. And all of the people that we're trying to do deals with, all of the small to mid-sized to large customers, they're all gathering here on EverResi Media. Come find them.